Welcome to 2026. From this vantage point, the world looks familiar, yet fundamentally different. The skyline is dotted with structures that were just blueprints a few years ago. Below, the arteries of the city are already beginning to pulse with the lifeblood of a new day. It's a world that promises unprecedented opportunity, a world that moves at a pace that can feel both exhilarating and overwhelming. The world feels faster than ever, you know. It's not just a feeling, it's a measurable reality. The speed of information, the velocity of commerce, the rate of innovation, all have accelerated to a degree that would have been unimaginable just a decade ago. Technology is the engine of this acceleration. It has profoundly reshaped the fabric of our daily existence, changing how we live, how we work, and how we connect with one another. We collaborate with colleagues across continents in real time. Our homes anticipate our needs, and knowledge that once required a trip to the library is now instantly accessible in the palm of our hand. This constant evolution is the new normal, and nowhere is this relentless speed more apparent than in the financial markets. They act as a global nerve center, reflecting this pace in every tick of the tape. News, rumors, and data, both significant and trivial, travel across the globe in an instant, triggering market reactions before most of us have even had a chance to process the information. In this environment, new companies, powered by disruptive ideas, can rise from complete obscurity to become household names seemingly overnight. Their stories are amplified across our feeds, creating a powerful narrative of rapid, almost effortless wealth creation. Given this backdrop, it is easy to feel like the old rules of investing no longer apply. There's a pervasive sense of urgency, a fear of missing out, often called FOMO, that whispers or even shouts that traditional patient strategies are obsolete. Many people feel a constant, nagging pressure to do something, to act now, to chase the latest trend before the next big opportunity vanishes forever. This pressure isn't just external, it's internal. We see stories of overnight success and question our own, more measured approach. This feeling is entirely understandable. It's a natural human response to a rapidly changing environment. But it is also, paradoxically, one of the greatest and most insidious risks an investor faces today. The temptation to abandon a sound, long-term plan in favor of a short-term gamble is the siren song of modern markets, and it has led countless well-intentioned people toward financial disappointment. So, let's pause for a moment and step away from the noise. Let's ask a critical question. What if the most important parts of successful investing, the core principles that build lasting wealth, have not changed at all? The truth is that while the tools, the platforms, and the headlines are dazzlingly new, the fundamental operating system that drives our decisions, human nature, is not. It is the same operating system our parents and grandparents had. The same powerful primal emotions that led to financial ruin a century ago are still with us, hardwired into our psychology. Greed, the intoxicating desire for more, faster. Fear, the paralyzing panic that leads to selling at the worst possible moment. Impatience, the inability to let a sound strategy play out. And overconfidence, the dangerous belief that we can outsmart the market. These behaviors are timeless. They just have new, high-tech ways to express themselves in 2026. Think about it. Social media, with its algorithmic amplification, can turn a baseless rumor into a market-moving event in minutes, creating flash crashes or speculative bubbles out of thin air. And our investment apps, designed with the same addictive feedback loops as games, make trading as easy and frictionless as ordering food. A complex financial decision is reduced to a simple, satisfying swipe. This constant stream of information, alerts, and social pressure creates a perfect storm for emotional, reactive decision-making. It's an environment that preys on our worst behavioral impulses. This guide is about building a defense against that storm. It's about learning to navigate the noise, not by trying to predict the next headline, but by understanding the timeless mistakes that trip up most investors. It's about recognizing these behavioral traps in ourselves and in the market around us. By doing so, we can build a stronger, more resilient investment philosophy, a personal defense system that outlasts the fads, the panics, and the fleeting headlines of the day. There is a powerful myth that whispers in the ear of every investor, from the seasoned professional to the absolute beginner. It's a seductive story, one that has been told and retold for generations, adapting its form, but never its core message. It says the path to wealth is not a long, steady climb, but a single, brilliant discovery. The myth is this: find the next revolutionary company before anyone else, invest a small sum, and watch it multiply into a life-changing fortune. We are constantly bombarded with tales that reinforce this belief. You hear stories of someone who bought into a fledgling tech company in their garage and became a millionaire, or the person who saw the potential in a new cryptocurrency when it was worth mere pennies. These stories, amplified by media and word of mouth, make investing feel less like a financial discipline and more like a treasure hunt. They make it seem like the key to success is finding that one elusive needle in a vast, global haystack. In the modern era, this myth has found a powerful new engine. In 2026, countless investors spend their days chasing hot stocks. These are companies promoted relentlessly on social media, championed by influencers, and pushed by breathless 24-hour news reports that thrive on urgency and excitement. The narrative is always the same. This is the next big thing. Get in before it's too late. Lured by the promise of quick, astronomical returns, many investors jump from one exciting idea to the next, perpetually hoping to catch lightning in a bottle. But this constant chase is often a frantic and ultimately fruitless endeavor. The truth of successful, long-term investing is far less glamorous, but it is also much more predictable and, for most people, far more effective. It's a truth grounded not in speculation, but in discipline, patience, and a deep understanding of what you are actually buying. The danger of these so-called hot stocks is their volatility. Fueled by hype, their prices can rocket up with astonishing speed. But what goes up that fast, without a solid foundation, can fall just as fast, and often even faster. The same social media chorus that sang its praises can turn silent or move on to the next trend, leaving a trail of financial wreckage. This creates a perilous dynamic. For every big winner, often an early insider or a lucky speculator who gets out at the perfect moment, there are thousands who lost. These are the retail investors who, driven by the fear of missing out, bought at or near the peak. They provided the exit liquidity for the early investors who were quietly selling their shares and locking in their profits. A rapidly rising stock price can create a powerful illusion of success, masking weak or non-existent fundamentals. But hype is not a business model. A compelling story is not a substitute for revenue, profit, or a sustainable competitive advantage. Eventually, the excitement fades and reality catches up. The company must prove it can actually operate a profitable business, and if it can't, the stock price will inevitably return to a value that reflects its true, underlying worth. The modern information ecosystem, with its instant updates and constant chatter, accelerates these cycles and weaponizes our own psychology against us. This constant stream of information fuels a powerful emotion: FOMO, the fear of missing out. Seeing a stock double in a week triggers a primal urge to join in, a fear that we are being left behind while others get rich. When acting on this impulse, investors are no longer making a calculated decision based on the value of a business. They are buying a lottery ticket. They are betting on momentum, on hope, on the chance that they can sell to someone else at an even higher price before the music stops. This strategy, known as the greater fool theory, is not investing. It's pure speculation. Chasing past performance is a statistically proven path to disappointment. By the time a stock's incredible gains are making headlines, the biggest price movements have often already occurred. The smart money has already moved on. Instead of chasing these sirens of the market, a more prudent approach is required. It involves shifting your mindset from that of a speculator to that of a business owner, focusing not on the flickering price on a screen, but on the enduring value of the enterprise behind it. A common myth is that fees are a minor detail. If a fund promises big returns, a small skim seems irrelevant. We fixate on potential returns and dismiss the cost. Over decades, that small detail becomes massive, a slow leak. Fees are a reliable predictor of future returns. High returns are not guaranteed. Fees are. $10,000 compounding at 7% can become about $76,000. Add a 1% annual fee and it drops closer to $57,000, roughly a $20,000 loss. Today's products carry layered costs: management, trading, administrative, advisory. An expense ratio can be a yearly hurdle before any profit. Be cost conscious. Favor low-cost index funds or ETFs that match the market, often under 0.1%. Always ask, how much am I paying? If the answer is unclear, that is a red flag. Humans are social creatures. Following the group usually keeps us safe. In investing, that instinct can be catastrophic. If everyone is buying, we assume it must be smart. When it hits parties and prime time, the biggest gains are likely gone. Crowd enthusiasm inflates bubbles. Prices rise on stories, not sober analysis, until they pop. Following the herd means buying high and later selling low. Counteract the urge with a personal anchor. Write your thesis before you buy. Why am I buying this? If it is because others are, stop. Base your thesis on fundamentals: moat, earnings power, durable demand. When the crowd panics or gets greedy, return to your words. Decide with logic, not emotion. Your thesis is your rationale and your lifeline. In the world of investing, there's a seductive myth: the idea that you can outsmart the market. It promises the ultimate financial fantasy: selling just before a crash and buying back right at the bottom. This is incredibly appealing because it speaks to our desire for control and our fear of loss. We see charts and headlines and think, surely there must be a signal I can use to get ahead. This belief turns investing from a long-term strategy into a high-stakes guessing game. But here's the stark reality. Successfully timing the market requires not one, but two perfect decisions. You have to be right twice. First, you must correctly identify the peak to sell, distinguishing a true market top from a temporary pullback. Sell too early, and you miss gains. Sell too late, and you've already incurred the losses you were trying to avoid. But the second decision is even harder: knowing the exact moment to buy back in. This must be done when fear is at its absolute peak, when every news report is screaming doom, and your instincts are telling you to run. The psychological pressure is immense. Most who sell wait for good news to return, but by then, the market has typically already staged a powerful recovery. The market structure makes this nearly impossible. Its most dramatic movements are concentrated in very short periods. The best days, which drive the majority of long-term returns, often sit right next to the worst days. The cost of being on the sidelines is staggering. Research has shown that if you miss just the 10 best days in the S&P 500 over a 20-year period, your total returns would be cut by more than half. Miss the 20 best days, and your returns could be almost completely wiped out. These crucial days are unpredictable and are the reward for staying invested through uncertainty. Even the professionals with their powerful algorithms and teams of analysts consistently fail at timing the market. The vast majority of actively managed funds fail to outperform their passive index benchmarks over the long run, precisely because of failed attempts at market timing. In our modern age, we are flooded with data. But more data doesn't give us more insight. It mostly just creates noise. a constant barrage of opinions and predictions that encourages impulsive action. Reacting to this noise leads to whipsawing, where you sell after a drop and buy back after a rise, effectively locking in losses and flipping the fundamental rule of investing on its head. This constant trading also racks up transaction costs and creates tax liabilities, further eroding your returns. So what is the fix? The solution is to stop trying to time the market and instead focus on time the market. The most effective way to do this is through a strategy called dollar cost averaging. This simply means you automate your investing, committing to invest a fixed amount of money on a regular schedule, regardless of what the market is doing. This disciplined approach has a powerful mathematical advantage. When prices fall, your fixed investment automatically buys more shares. When prices rise, it buys fewer. Over time, this can lower the average cost of your shares, but its greatest benefit is behavioral. Automation removes emotion from the equation. It prevents you from panic selling during a downturn or getting greedy during a bubble. It enforces discipline and frees you from the impossible task of waiting for a perfect day that will likely never come. By embracing time, not timing, you align your strategy with the proven engine of long-term wealth creation. Building a house with no foundation, no emergency fund. The myth says every spare dollar must work in markets. Cash feels wasted. Yes, cash yields less and loses to inflation, but life is unpredictable. Emergencies are inevitable. Without a cash buffer, you will be forced to sell investments, usually at the wrong time, locking in losses and derailing goals. Fix. Build and maintain an emergency fund first. Save 3 to 6 months of essential expenses, rent or mortgage, utilities, food, transportation. Keep it safe, liquid, accessible, like a high-yield savings account. It is insurance that buys you time and options and peace of mind. Once funded, invest the excess with confidence toward long-term goals. The silent penalty of ignoring taxes and rules. It's not what you earn, it's what you keep. Different accounts have different rules and tax treatments. Hold under a year, you likely pay ordinary income rates. Over a year, long-term rates are lower. Rules change. Over-contributing or withdrawing the wrong way can trigger penalties and taxes. Learn basics. You do not need to be a tax expert. Prioritize tax-advantaged accounts, 401k, IRA, Roth IRA, to grow tax-deferred or tax-free. Maxing these first shields growth from taxes. In taxable accounts, aim for long-term holding to reduce taxes. Smarter account use turns good returns into better keep after-tax returns. Letting fear and greed steer the ship. The myth says, trust your gut, buy when confident, sell when afraid. Truth. Fear and greed are the most destructive investing emotions. They cause buying high and selling low, again and again. This behavioral gap explains why many lag the market. Today's constant alerts spike emotions. Commentary is designed to provoke. Fix. Build a system. Write an investment policy statement with goals, horizon, and buy-sell rules. Rebalance periodically to systematically sell high and buy low. Automate contributions to keep emotions out. A written plan gives clear instructions when emotions run hot. The simple path to success in 2026 and beyond. Investing feels complex. The volume, speed, and product sprawl are dizzying. Decades of history show successful investing is surprisingly simple. Get a few behaviors right and avoid the big mistakes. It is a marathon. Steady pace beats sprinting. The obstacles: chasing hot stocks, ignoring fees, following the crowd, timing the market, neglecting an emergency fund, forgetting taxes, and letting emotions take control. Like good health, the principles are simple. Spend less than you earn, save the difference, and invest it patiently. Use a diversified, low-cost portfolio for a very long time. Build your foundation. Emergency fund, low costs, diversification, automation, and a written plan. Tune out the noise and let compounding work. This path can carry you through whatever comes next.